so many ways to structure real estate deals. Today, I'm going to focus on a debt structure, what it is, what it isn't, what are the benefits of that, and who may not be right for a debt structure investment. So let's say we're going to go purchase a property and we bring on one or more investor partners and they loan us money in order to go purchase and probably improve the asset we're purchasing. This is called a debt structure or a loan. The way it works is investors loan us money and they get a fixed interest rate on that loan. That loan is secured by the real estate, though they do not actually own the real estate itself. So in this case, let's say we have investors who loan us money to purchase an asset and we give them a 10% fixed interest rate. So we would start paying that 10% out just the month after close. They would start getting paid immediately. We would pay them their interest payments, and then when we returned their principal, that's when interest payments would stop and the investment would be complete. So it's a pretty simple structure. Now, it is not ownership in real estate, which means the investor in this case, as they're giving a loan, they do not own real estate, so they would not have depreciation or appreciation, some common benefits of owning real estate. So what are the benefits of a debt structure? The first is, like I mentioned, you get paid out right away in a debt structure if you're an investor in one. So most of the time, when you have ownership and you're maybe doing a joint venture or some kind of structure where you have equity stake in a property, you're not getting paid out right away because most real estate doesn't cash flow for a few months. You would want to kind of wait and pay that out. Now, in a debt structure, you start getting paid out right away. You also get paid out more money right away. So your cash on cash returns tend to be higher, significantly higher in a debt investment versus an ownership structure. So let's say you are getting that 10% interest rate right away. In most investments where you would own an equity stake, you would start getting paid out, let's say around month 6th. And usually that would be maybe 4 or 5%. Maybe the next year it goes up to 6% and maybe you get to 7% or 8% over years. Most of your return in an ownership stake comes at the end, let's say after 5 years when the property is sold. So that's different than a debt structure where you're getting that 10% out of the gate from day one. So you do get higher cash on cash returns. Debt structures tend to be lower risk as well. So that is a 10% guaranteed amount compared to, let's say, an equity structure where you're likely going to get a higher overall return. You just wait longer for it and it's a little bit riskier in that it's dependent on the project plan of the property and the, interest rate environment, economic factors, all of those fun things. So you reduce that risk when you go with a debt investment versus an equity investment. So who is a debt investment not right for? First off, if you really, really need depreciation, then a debt investment is probably not right for you since you have a loan backed by real estate, secured by real estate, but you don't actually own the property and are not getting depreciation benefits. And the second is if you're really looking for a higher risk, higher return type of investment, then perhaps a debt investment would not be right for you. If you're looking maybe to split between some debt investments and some equity investments, or you have a lower risk tolerance, then perhaps the debt investment would be right for you. But if you are really taking the chunk of money you're looking for, just higher risk, higher return, then perhaps a debt investment would not be the right method. So hopefully this helps you understand what a debt investment is, what the benefits are, and who may or may not be suited for a debt investment.